Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues, Asia Drobnik from our Financial Institutions Ratings team, and Kali Sirugudi from our Residential Mortgage-Backed Securities Ratings team. Today, we'll be covering the topic of UK building societies, as we have recently produced our annual look into the sector. Forthcoming challenges and risks to UK building societies' profitability and asset quality are at the forefront as they face the impact of inflation, interest rate rises, house price declines, and general deterioration in borrower budgets with the prospect of rising unemployment in the future. Can the sector absorb the continuing macro pressures? Will their profitability benefit from higher interest rates in the coming quarters despite these challenges? We will discuss these with my colleagues shortly, but first, let me set the backdrop with a macro outline on the current situation in the UK. KBRA currently rates the UK at a AA level with a stable outlook, as the sovereign is a large, wealthy, resilient, and has a diversified economy. The country has high-quality institutions and strong governance factors, although some metrics have been challenged by Brexit. The current inflationary environment poses challenges to both government finances and the domestic economy. This pressure is more pronounced in the UK compared to peers because of government debt indexation and household debt structures. The prospect of elevated and persistent inflation in the UK remains a credit concern. The latest reading showed a year-over-year inflation rise of 10.1% in March. While the price growth persists at a higher level than exists in the US with 5% and the Eurozone with 6.9%. The overwhelming contributor to inflation in the UK has been high food and energy prices, while supply chain dislocations have placed upward pressure on goods prices. Although both of these external inflationary pressures have eased in recent months, there are reasons inflation could be sticky at the UK and persist above target. The UK appears particularly price sensitive given the net importer composition of the economy. Brexit has added to certain underlying pressures for domestic inflation, particularly within core goods and the labor market. And Brexit constricted the economy's openness, so prices have greater elasticity to supply and demand pressures. The unemployment rate currently stands at 3.7%, indicating a significantly tight labor market, which stems from supply-side challenges similar to many advanced economies globally. COVID and Brexit have together reduced the UK labor market supply, while the drop in a migration of skilled workers from the European Union has distorted labor dynamics in certain sectors such as construction, hospitality, and manufacturing. The Office for Budget Responsibility, or the OBR, anticipates the unemployment rate will gradually rise to 4.9% in 2024 as the economy slows, demand ebbs, and growth stagnates. While this would represent a significant increase from the current unemployment rate, it would remain low versus historical levels. Inflation and interest rate rises will negatively impact household budgets in the UK. Increased unemployment would elevate household stresses and could pressure mortgage portfolios. However, household savings built up over the pandemic, the delayed impact of rate rises, and energy pricing changes and support, as well as strong employment levels, have enabled UK households to weather the increased stresses to date. Now, to take you through the impact of all of this upon building societies and mortgage portfolios, I have with me my colleagues Asia and Kali. Welcome, Asia and Kali.
Thank you, Gordon. Great to be here.
Thank you, Gordon. Always a pleasure.
So, Asia, let's start with you. Given the challenges in the economic environment, the slowdown in the mortgage market and the March liquidity stresses seen across the US banks and Credit Suisse, have your credit views on the UK building society sector changed at all since we spoke about a year ago?
To simply answer your question, our credit view on the sector hasn't changed since last year. But let me expand on this. Despite all the challenges you mentioned, we continue to believe that UK building societies, especially the large, better performing small and mid-sized institutions, have sound credit profiles, and the sector can absorb the continuing macro pressures. But just like we always highlighted, given that the societies have undiversified business models, they are inherently vulnerable to increasing cost of living, rising unemployment, and a housing market downturn. In addition, over the coming quarters, we expect the sector's profitability to be under pressure and asset quality to deteriorate. But those forthcoming challenges are mitigated by the society's generally sound capitalization, stable funding, and strong liquidity. So let's zoom in on funding and liquidity, the elephant in the room in the light of the liquidity stresses you mentioned. The societies are mutual institutions, right? They are owned by and working on behalf of their customers. And as a result, they have traditionally offered better interest rates on savings and mortgages. With this in mind, it is not surprising that over 70% of the sector's total funding comes from stable retail customer deposits. Key here being stable and retail. Also, most societies have sound liquidity profiles. According to our calculations, the average liquidity coverage ratio last year was over 200%.
You mentioned that profitability is expected to be pressured in the coming quarters. Can you expand on this?
Sure, but let's start with the last year performance of the sector, which saw further improvement benefiting from base rate hikes, which more than compensated for higher loan impairment charges. So let's focus on margins for the moment. They benefited from slow pass-through rate to savers and reached levels previously seen in 2014. Given the higher interest rate environment, NIM is likely to remain above pre-pandemic levels. Yet, we believe that further uplift is likely to be limited due to several factors. Slowing economy weighing on credit demand, narrowing mortgage spreads, increasing funding costs, and base rate hikes likely coming to an end. Almost all societies reported higher loan impairment charges last year. And with the weakening economic outlook, we expect them to remain high in the medium term, but within the normalized ranges. The challenging operating environment is also impacting loan growth. And this is important due to the sector's lack of revenue diversification, as the society's profitability heavily depends on their ability to grow their mortgage books. Overall, in the coming quarters, the sector's earnings will likely keep benefiting from higher interest rates. At the same time, we expect profitability to be pressured by increased loan impairment charges and the ongoing slowdown in mortgage lending.
Thanks, Asia. And another credit risk you highlighted was the expectation of weakening asset quality. As highlighted in my introduction, the UK certainly faces its challenges. Can you add a bit more color in terms of the way that building societies are expected to manage this challenging environment?
Yeah, absolutely. In line with their peers, the society's asset quality held up well last year, with average non-performing loan ratio at 1.2%, broadly unchanged since before the pandemic. But the sector saw an increase in stage 2 loans. On average, they almost double. This was due to model-driven adjustments reflecting risk related to economic slowdown, higher cost of living, and potential rate shock for borrowers reaching fixed-term maturity. We expect the sector's asset quality to deteriorate over the coming quarters as higher interest rates and inflationary pressure continue to feed to the economy and customers' affordability. Saying this, the society's generally conservative loan-to-values should help to mitigate any potential loan losses.
I agree with Asha's assessment on the asset quality. And to add, given the interest rate increases and a sustained higher cost of living, KBRA expects delinquencies for UK mortgages to rise. Borrowers at the lower end of the income spectrum are particularly vulnerable. After receiving government support during the pandemic, borrowers will be unable to rely on state support and lenient lenders. Repossessions have increased after the pandemic lows, but have to date been at the lower end of historical levels. Self-employed borrowers with income volatility, those on variable rates of interest, and borrowers categorized as vulnerable are likely to struggle in 2023 and 24. The quantum of any increase in delinquencies is contingent on employment and UK borrowers' resilience to persistent high inflation and energy prices, which can squeeze the disposable income of borrowers, particularly those on the edge of affordability and those with high level of leverage. A meaningful proportion of mortgages needing to remortgage at the end of the teaser period will face a payment shock at higher fixed and or variable interest rates. On the positive side, unemployment levels are unlikely to play an immediate role in driving defaults. And the last thing to add to it is not just building societies, the UK, the other lenders in the mortgage market have experienced the nature of the difficulties borrowers have faced in the UK during the pandemic period. And that experience in dealing with stressed borrowers should certainly hold good for the expected increase in delinquencies in the couple of years from now.
Thank you for that additional color, Kelly. So maybe if we just now turn into the housing market, what's happened in recent periods with regards to house prices, and what is KBR's expectations with regards to them in the UK moving forward?
So the background to the current scenario is, to begin with, the pandemic period. The UK's housing market showed strong growth since the pandemic's onset, with limited supply and good affordability. However, after that prolonged period of low interest rates, rate hikes through to 2022 have weakened affordability for house purchases. This has resulted in a housing market slowdown, with house prices declining 5.5% from the peak at the national level, according to the nationwide house price index. House prices have declined in all regions in the UK since Q3 2022, with declines ranging between 4.3% to 6.4%. Scotland and Wales showed the steepest declines so far, with house prices falling in excess of 6%. On a year-on-year basis, house price changes range from a more moderate minus 3.2% to a positive 1.4% across the regions, and a decline of 1% on average across the UK. The higher cost of living and the end of the Help to Buy scheme for first-time buyers has certainly exacerbated affordability pressures, contracting demand for house purchases. Now, given the increase in affordability pressures, it is logical to expect a fall in the number of property transactions. Now, if you look at the statistics available on that, the number of property transactions per month fell to 76,920 in February 2023, a 64% decline in transactions, versus 214,540 property transactions in June 2021. And that number in February 2023 is also below the monthly average of 104,044 transactions since the beginning of the pandemic. So KBRA expects a further fall in property transactions as increases in cost of living and higher interest rates worsen mortgage affordability. Overall, KBRA expects the UK house prices may see a further correction in both 2023 and 2024, as eligible loan amounts for first-time borrowers combined with borrower deposits fall short of purchase prices.
Thank you, Kali. So what about the mortgage lending picture? Obviously, the UK building societies are a key part of that. What are the trends there looking like?
So the key trends I see, Gordon, is an increase in remortgaging activity as compared to borrowing for purchase of houses in general. Specifically, annual gross mortgage lending increased 2.1%, reaching £322 billion in 2022. Now, growth in mortgage lending has been increasing slowly, but has yet to return to its peak volume of £372 billion observed in 2007. Higher interest rates have adversely affected borrower affordability, as I've stated before, and so did Asia, which should lead to lower eligible loan amounts, making the ability to purchase a home more difficult. Lending volume for house purchases was 57% of all new lending, and it fell in comparison to 2021 levels, which was at 66% of all the new lending in 2021. The remortgages was at 35% of new lending, which increased from 28% in 2021. Buy-to-let lending accounted for over 13% of new lending in 2022. Remortgage lending ticked up in Q4 2021 as a threat of rate rises began to take hold and increased further to 36% of new lending in Q3 2022. The total outstanding value of mortgage loans at the end of Q4 2022 stood at £1.6 trillion, 2.7% higher than in December 2021. However, after the spike in interest rates in September 2022, mortgage lending growth has settled at a lower level, albeit still higher than in 2021. So as regards mortgage lending, KBRA expects the increased rates to curb mortgage lending levels further over the next few quarters. I hand it back to you, God.
Thank you very much, Kali, and thank you very much, Asia, for your insights. So as highlighted, despite UK building society's vulnerabilities in the face of the growing macro challenges, KBRA believes that the sector's credit profile, particularly for the large and better performing mid-sized or small societies, as highlighted by Asia, has notably resilient characteristics. That being said, the sector's modest profitability, although supported by a higher interest rate environment, is expected to be pressured by higher impairments and a continuing slowdown in mortgage lending, as highlighted by Kali. The sector's asset quality remains strong, but KBRA expects it to deteriorate over the coming quarters as the implications of higher interest rates and inflationary pressure continue to feed through to the economy and customer affordability. However, as has been the case for a number of years now, KBRA continues to believe the society's generally conservative loan-to-value ratios and supportive credit profiles should help to mitigate any potential loan losses. KBRA, of course, actively monitors this situation and the development in this market, and you can find greater details in our report on our website, kbra.com. Make sure you are registered to receive the latest commentaries and, of course, are subscribed and have liked our podcast. And, as always, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you all out there as we continue to adjust to the challenges ahead.